Hi, everybody. It's Matt Scudero with the Credit Research Foundation. Why don't we kick off our session today? First, it's great to have you with us. Second, this is a part of our October forum. Even though we are in November, this is a user group session, and I'm super excited to have the team from Experian with us. In case you don't know, Experian is a platinum partner of CRF, and we want to thank them on many fronts, but two of those would be as a constant contributor of educational content to the foundation, and two is as a supporter from an economic standpoint, which helps the foundation continue its efforts. So to the entire Experian team, I want to say thank you for your continued support. We have a great session today. The title, Addressing a Dynamic Market, Solutions to Combat Commercial Fraud and Strategies to Ace Alternative Data. And at this point, I'm going to pass it over to Mike Myers, who will do some intros and get us going with today's session. So Mike, it's all yours.
Perfect. Thank you, Matt. And, thanks to all of you that are attending. We really appreciate our partnership and look forward to your feedback. So thank you for the time, guys. Wanted to just kind of tee up some of my team that will be talking to you about several different topics today. And as always, really looking for an interactive session. I want to get your thoughts on what I think we all can agree is a challenging economic situation. As you focus more on account management, are you seeing an uptick in collections? Where do you really feel this economy is headed? I know you all don't have a crystal ball. We don't, unfortunately, either, but really looking forward to learning from what you're seeing in your space and also helping us understand so that we can influence the roadmap accordingly based on some of your needs and areas where we think we can help you. So start that off today. We're going to really talk about some small business trends and some of what we're seeing from an economic picture. Rody Oldham will kick us off, then we'll step into a little bit of work we're doing in the fraud space. Really an increasing problem, as we've all moved to a much more work from home environment, much more digitization across the board. Fraudsters have reacted accordingly. And we've got some stats and some different topics to share with you on that. And then we'll wrap it up with an area I'm really focused on, kind of non-traditional data. We often call it alternative data. I'm not sure that's the case anymore, right? Is there really such a thing as alternative data? I think in this economic situation, we've got to be open and really look at different sources beyond our conventional trade payment, public record information. And we have some sources that we've been exploring that I think could help you and help pinpoint some interesting facts and really attributes in your own portfolio. So we'll wrap up with that. But without further ado, I'll go ahead and kick it over to you, Brody, and you can educate us on some small business trends.
Hey, thanks, Mike.
Sure.
I appreciate it. It's fun to be during one of these times in our economic growth and recovery as part of just an outlook on the next year or two. So good to be with you here today. As we go into this next slide, what I want to just touch on is that we really are in an economy that is in the rebound. So we've talked about V-shaped recoveries as far as the economic trend to bounce back to where we were immediately after a recessionary period. And, as we move forward, what we're seeing is that with continued COVID spread, that angle of the V is spreading out a little bit and a little bit more, and it's turning into more of a checkmark type of an economic recovery. Now, some of the good things that we're seeing, the GDP is recovering pretty well and even a little bit better than expected here in the third quarter. So coming up about 33%. We see unemployment has bounced back. As a lot of the reopening occurred within the market with small businesses, some of those furloughed employees were brought back in pretty quick. So we bounced up pretty high back to that, a pretty sad April, May, and June where we were down to those depressionary or Great Recession levels of unemployment. Now we're into the single digits again and below 7% unemployment. So a pretty good bounce back. Now that has slowed a bit as we're coming into the end of 2020. And, we look for the types of businesses that are going to be thriving during this time. We've seen, a lot of closures. We're going to talk about some of those business closures coming up, but we've seen a lot of starts too. So businesses, new applications for business starts have been up to record levels this year. It's been trending up since the Great Recession, but we are at a historical high this year of business starts. When you go through a recession, a lot of that innovation spark has really activated and people are out there trying to open new businesses. That brings some challenges for you, but it brings opportunity as well. We looked at the way that lenders performed during this time. If we look back to April and May, lenders were pretty well capitalized. They turned on their recession plans as far as underwriting. What that did was allow us to stay pretty stable, even through some of the volatile times. But what we're seeing now even is that capitalization has grown, expecting some volatility toward the end of the year. A lot of our lending partners are seeing that, even with a change in administration and upcoming into some of the forbearance and moratoriums on collections, that they feel some stability there in the market. And so they're calling back some of their capitalization, are able to reassess where they will deploy some of that and invest. Some good things there. Now, if we look at a teeter-totter here, you can have some of the good pieces, but it comes with some of the challenges as well. And when we look at the teeter-totter, we're really looking at those temporary businesses going to really permanent closures. And so as we go forward, we're going to talk about some of the ways that you can look at different businesses to make a differentiation using some alternative or non-traditional data sources like Mike mentioned just a minute ago. Some of the other things that you'll see is that we've seen a slowdown in foot traffic. Now it bounced in the middle of the summer and it's back up pretty good, but it hasn't reached those pre-COVID levels. A lot of folks aren't very comfortable yet to get out and explore their environment and go into stores. A lot more of the digitalization of that retail space. So there are some challenges there where some industries just haven't reopened, but it has pushed us into a space where there is some acceleration in that need for the digital interface with customers. And that's going to bring a challenge to a lot of our lending partners as they look for ways to keep that customer experience high, knowing that they're not going to be able to meet face-to-face with a lot of their customers. Now, some of the other challenges that we're seeing as we get into the end of the year is we're seeing delinquencies continue to rise. Now, it's not rising as quickly as expected because of some of the stimulus that we received, but we still do see delinquencies on the rise into the third quarter. So the other things that you should be cognizant of as we're getting into this time is with a new administration coming in, there's some expectations for additional regulatory oversight that we'll see. We'll see some increased spending that'll come in. That's going to be challenged a bit in the new administration, and we'll see some inflationary pressures continue to rise as that spending increases. The biggest thing here, you look to the right, is that COVID spread. We're in the third wave here, a really big spike. And it hasn't really leveled off at this point. We're hoping that it will, all of us, as we look for a vaccine, but that could challenge us with additional closures. And, as we talk amongst ourselves, even before this call, closures are starting to happen in certain regions. So being able to identify those regions, I think, will be very important as we go forward. And we have tools like the COVID Risk Index and others that we'll talk about today that allow you to look at two businesses and really make a differentiation between the two, dependent on their location, the macroeconomic impacts that are there, even their credit health themselves. So I think a lot of that will play into strategies you go forward all the way through the life cycle. So from the very beginning, account management through to your pre-collection, pre-treatment strategies into collections and ultimately decisions on the account itself. So if we teeter a little bit more, back the other way into the positive, some of the things that you're going to see with the new administration coming in is that we'll probably get a bigger stimulus package than was initially discussed during coming out in October. So we'll see one most likely in January as we get closer and closer to the new administration. What that'll do is that'll keep small businesses operating. We know that helped during the first and second waves of the COVID outbreak. During this third wave, we get another pickup here of stimulus. It's going to help us into 2021. With the continued spread, we're going to see that, again, that check mark of an economic recovery really stretch. So as we thought that we'd be back to normal around summer of 2021, I think that's really going to spread into 2022 now. To get us back to where we were. We need to really get the virus contained and get out in front of this and get everybody open back up and back to work. or at least have more of an opportunity to interact with businesses and small businesses through a digital portal. So when you guys are thinking about your business, one of the things, that Mike mentioned before, and to open this up to make sure that we have a chance to, communicate with you and get your feedback, is when we look at market stability. So again, coming into this time where we're going to have some delinquencies come up, forbearance and moratoriums begin to add that debt back onto the commercial balance sheets. We're going to see some stimulus possibly in January. So a little bit of teetering back and forth, good with the challenging. How do you see your business? Is it in growth mode over the next 6 to 12 months, or are you still in that wait and see? So why don't we'll put your questions in anytime. We can always come back. Why don't we go to the next slide? And we'll talk a little bit about PPP. So I know that PPP has been a big focus of our larger financial institutions and even some fintechs as they went out into the market to make this product available to small businesses, be able to bring them in, close them quickly. And for some of our lending partners, that opportunity to pick up PPP and be able to operationalize this process to onboard new businesses was a challenge, and it accelerated some of the development that was needed to create that automated forefront to put them more in a digital interface with their customers. And really what we found is that through this focus there, if you've watched the news and listened a little bit, you probably heard that there were some challenges with that onboarding, even with the process now in the forgiveness stage as we go forward. But as we work with the SBA and different agencies, we work to try to make that process a little smoother for our lending partners as well as for the small businesses themselves. That's really the purpose here with Experian, is to help lift up small businesses, and we look for opportunities to do that even with these government programs. Now, what you're going to see here is that as we look on the right-hand side, you'll see those that it's really an exploration of how PPP helps small businesses in the market. What you'll notice is in the first few months of the Paycheck Protection Program that was offered to small businesses, we saw that those businesses that were able to take advantage of the PPP program and be able to use that funding to support their employees and keep businesses operating, they performed better than those that didn't take out or take advantage of the program. And that's important. We really saw some advantage in this program being able to maintain that stability within small businesses as we went forward. In August, though, we saw a transition. And in August, what happened was that this funding that had been given in April and May began to run out for small businesses. And as it ran out, we saw delinquencies begin to rise, and they're still rising with a higher velocity for those that took out the PPP than those that didn't, really because they relied on that cash flow to support the business itself. And those that are a lot of those that are closing their doors now are what we might call zombie businesses. And we talked about, the last time we got together, we talked about Frankenstein fraud, those fraudsters that would come in after a business closed and they'd pick it back up and, open up accounts for a closed business and represent themselves as that closed business. So like a Frankenstein, we're always around Halloween when we do something like this. Now we get into small business open and closures, and we have these zombie businesses. And they're the ones that should have really closed their doors before April, before even March. They were on their last legs, and the PPP program held them up. Well, a lot of those now, without that cash flow, they're not getting the same foot traffic that they would, and so they're being challenged, and so those delinquency rates are going up. You see those that didn't take it out are a little more stable, still having a pickup in delinquency, but as the market transitions, but not at the velocity of those that took advantage of the program. Now, what we'll look at as you think about PPP2 is that PPP, the program, what an advantage of this is SBA has opened this up for 150,000 plus. You can see who got a PPP loan. You can also, I think in the past week, a federal judge is going to set a deadline of November 19th for the rest of those SBA loans, the PPP loans and EIDL loans to be exposed, who those programs who participated in those programs, so a much wider swath of those PPP loans. What we're finding at some of our lenders is, and one that I talked about just this week, or talked to, about 40% of those that came in on the PPP program that they supported were unique. They weren't customers that this bank had ever seen before, so they were new. And so what it did was give an advantage for them to go out and solicit, identify areas where they could help these customers with other products that they offered. We were able to help to look at these particular accounts and help them to identify ways that they could offer products that fit really the need of the small business, especially when they're in a cash flow type of a crunch. What could we help them do to bring up small businesses? So it's definitely helping across looking for new use cases for this type of data, looking for new use cases just to help small businesses. And we're going to talk about, in some of the other parts of the PPP program where some of our products could definitely help in the next round of PPP, but they'll also help in our evaluation of the PPP loans that we currently have or we're booking or bringing on to book to make sure that they are screened appropriately, that we know who they are, and that we can continue to grow that relationship as they come on board through some of these government-supported programs. So I think those are definitely ways that the PPP will impact, from a high level. What I want to see now is if you guys have an opportunity, you've gotten your question box open or your comment box open, take a minute here and think about the PPP program, what we saw in these first two waves of COVID and how it was supported through April and May. And tell us a little bit, give us some insight, if you would, to tell us a little bit about how the PPP program has impacted you. And as you're thinking about some of your future strategies, what could we do for you, or questions for you in the usage of the PPP data, or what are some of the things that you're looking for from us to help promote your next program or participation within the PPP program?
It looks like we may have two chat, so let's share those. So the first one I have, Brody, is business has been booming, construction industry being driven by residential. So I think it was more of a comment than a question, but any thoughts from your side on that, or should we go to the next question?
No, I definitely think that with a small consumer residential market, we've seen an uptick in those. We've seen the housing market be pretty strong through this. What we're seeing is that PPP is holding up a lot of these consumers that have mortgage payments. What we'll see is that some of the forbearance and mitigation programs or moratoriums are slowing down for the end of December. We're going to see some of that debt come back on, especially even in rental payments for some participants. So we're going to see delinquencies rise both in commercial and consumer. So we may see a bit of a slowdown here in construction of residential if the foreclosure moratoriums are lifted coming into the end of the year, and we see not another stimulus package for a couple more months. So we're certainly mindful of that, and we'll continue to monitor.
I think the next comment that came in ties back to what you were just saying, and this is somebody that's in the construction space as well. And it says a number of our electrical contractor customers received PPP funds. It has helped us improve our DSO dramatically. I too am wondering if things will start to slow down. So very similar to what you had just said.
I think that's, as we look forward, we hope to keep that mortgage market strong. We'll look for opportunities in commercial leasing to pick up as people start to go back to the office. We're seeing some of that transition already occurring for companies. So as we look for the different types of subcontractors and the types of jobs that they work on, it will differ depending on the type of work that they're doing, whether it's consumer or commercial. I think from a residential property perspective, I think you're going to see more of an uptick there as the mortgage market remains strong. You'll see a bit of a slowdown in the commercial space as flexible leases pick back up, and we look for opportunities to really try to get people back in the office. If they don't, you'll see a slowdown in that market, certainly in some larger MSAs. So as we go to this, this last slide really uncovering the economy and what we're seeing, there's a lot of different areas to focus on as we go forward. We're going to look through the life cycle, and the questions that we get from our clients, you can see some of them here, really some of the main topics that we focus in on. It really goes across how small businesses will be resilient. And a lot of the products that we are coming out with, new data points, non-traditional data alternative, even point-in-time data versus our traditional historic data, give a lot of insight and differentiating and just more evidence on how resilient a business will be in a certain location with the macroeconomic impacts and other event factors that come into that small business. How strong will they be, and how can we support them as we go forward? So I'll end with that, and I know that we're gonna, as we talk a little bit more, and we're gonna start really from the front end here of the process, looking at, even from a PPP perspective, like we talked before, how do we bring a fraud perspective, a first look at some of these small businesses as they come in, and what are we doing really to address fraud here at Experian? And I encourage you to, as we're talking about this topic, it's a big one, throw some of those questions out, and we'll be happy to answer as we go forward. Thanks. Lee, I'll turn it over to you.
Thanks, Brody. Really appreciate the macroeconomic highlights and the market outlook there. I think that's really important. And I really like that last slide here, what you're illustrating. Just the spread of focus, right? The questions, the many different topics. It's a wide variety, and we're all trying to manage many different things at a single time. So, and that's why I think fraud is such an important topic right now, because the fraudsters are seeing the same thing too as well. What they see right now is opportunity, right? So let's talk more about that in this next slide here and what that opportunity is for them. And here's a big reason why fraud is such an important topic. When speaking to many of our clients, when I speak to many of our clients, fraud is top of mind, and they've indicated thus far is that they were forecasting actually a decrease in loss associated with fraud prior to the pandemic. But since the pandemic, if you went back and we speak to the same clients with the same surveys, it's a dramatic swing in the opposite direction. So what you see on your screen is a representation of the recent discussions I've been having and just how dramatic that swing we're seeing is. And majority of the recent conversations I've been having, as I mentioned, they're predicting a flat or decrease in losses prior to pandemic. Now it's a dramatic increase, and this is in multiple different fronts and multiple different verticals. And clearly, I would say fraudsters have a recipe for success. You hear and you heard right now, Brody just mentioned the PPP program, right? And the loans being issued through there. I've heard recently, from the SBA Inspector General, Hannibal Ware there, just mentioned potentially there's billions of dollars fraud hidden within these PPP loans that many of our financial institutions are managing through just right now. He even disclosed as much as 400 million of the funds that are distributed have already been seized by law enforcement. So you can see with many of the financial institutions struggling or managing some of this process that relates to fraud and how much this is already impacting with a portfolio like that. They just saw so much opportunity there, right? So as fraud increases and occurrences are increases, we should be especially concerned potentially one of the businesses or many of the businesses looking at adjust and how they should be adjusting, right? So can we move to the next slide here? I want to be able to show why this is so important for you and why this is important, right? So if you're one of these businesses I'm potentially showing on your screen that's really looking to rapidly automate. So I mentioned on the right in the right column there on your screen, there's a little bit under half of businesses who recently surveyed post-pandemic is they're accelerating their desire to move into many of the digital online interactions they want to be able to engage on their customers. That's kind of the new way many of our customers and consumers are expecting to interact with businesses now, having that faceless interaction, right? On the brighter note, I would say, though, is that 67% of the same businesses are accelerating their use of automation and AI, which I believe is truly critical to combat this fraud problem here, especially when you move to the online environment where you want to provide that efficient and streamlined experience for your customers without sacrificing your ability to identify fraudulent intent. The online channel by far is a preferred method, a preferred channel for many of the fraudsters, just because it's low friction for them right now, especially if you're not really secured and protected in the upfront process to detect fraud and to prevent fraud, right? So I think that's a big focus area for us today and a big focus of our discussion. Before we kind of jump into the different solutions to talk about how we want to be able to solve and be able to automate some of the fraud checks we want to be able to implement, I actually want to talk specifically about the fraud, actually, the types of fraud we're going to see in this next slide here. And really, it's associated to application fraud. So application fraud is where the fraudster is intentionally trying to mislead during the application process, where they want to establish credit terms with you in order to purchase your product and services. But it could also be a vendor supplier looking with a malicious intent, basically, to falsify many of their information, try to partner with you and working with you. Specifically, we're trying to solve for 3 types of application fraud. So I'm going to start from the left and work my way right here. Synthetic ID fraud is a new form of fraud type that's coming to the forefront. This is where the fraudster is basically taking a mixture of it's actually 2 types of fraud being mixed into one. It's the 2 following frauds I'm going to cover here. It's basically a mix of third party and first party. 2 subsets. The first subset here in the synthetic ID type of fraud is where you have a fraudster filling out your credit application, and the fraudster is providing information using multiple business identities and ultimate personal guarantors identities together into one. The second subset is a business who knows they actually don't have the credit history, but they know if they just kind of slightly tweak the application, just slightly, a little bit, so that it looks like they're actually a completely different business, and you end up actually pulling a different credit history on this business to basically pass your application process, right? So that's the second subset with synthetic ID. Now, moving towards this middle section here is the identity theft. This is the fraud type you're likely most familiar with. This is a fraudster stealing and using another business identity while filling out your application. And then lastly here, the first party fraud, which is reported actually by many of our clients as the most prevalent fraud attack they're experiencing, which can contribute actually up to 60% of your total fraud losses today. This is the business using their own identity, right? The people who they say they are, which is, and they know they have great credit history and they're applying credit with you in terms with you without ever intentions of ever paying back what the services and products they get from you. I think knowing the types of fraud is critical to understand how the fraudsters are attacking you specifically, because they require different solutions to solve for. And in the bottom below, they describe the type of behaviors you'll be able to see with these types of fraud attacks. So for example, you wouldn't say necessarily use a solution that looks to identify identity theft to solve for a first party problem, right? Because they're really different problems and information you're trying to isolate. So that's something really important to keep in mind. There's not a silver bullet solution that solves for all types of fraud. It does require us to bring in multiple solutions to make sure we tackle each of them very specifically and effectively. So next slide here, I'm going to talk a little bit more about the prevalence of these fraud attacks. So with these types of attacks, we want to be able to help you solve for, as we expect them actually specific to increase. So I have actually 2 different charts here I'm showing on the screen, one specific to synthetic ID, one to first party risk. So to read this chart, here's how I would ask you to interpret this. So the bar charts on both charts here, so the bar graphs indicates the number of client applications we are processing or are using our solutions to identify these fraud attacks. The line chart here, which you're seeing is increasing over time, right? That's indicating how many applications we are flagging as high risk through these different solutions. So in short, you can see it's pretty distinct, right? You see the number of applications drop off right around when the pandemic hit. But we start to see that many of these applications, even though they're dropping off, we're marking many of them as high risk associated with synthetic ID and fraud loss today. And we actually expect these fraud risks to increase and rise during this time as well. And I'll be able to speak to that too in this next slide. And these 3 bullet points here just illustrate that we continue to expect these problems to increase over time. Synthetic ID risk remains relatively steady or increasing over time, as you saw in the previous chart. One of our other solutions providers in BioHedge is actually reporting an increase of 200% first-time banking usage, meaning many of the new customers now are now online and interacting online with businesses that they've never done so before. This is actually a potentially high-risk population of new customers because they're more susceptible to fraudster schemes that are trying to steal their identities and misuse their identities, so account takeover. You heard mentioned previously by Brody around Frankenstein fraud, right? So someone where a business is being resurrected and utilizing a fraud scheme. So this is an opportunity basically for fraudsters to take advantage and take over some of these new customers, take over their accounts, and then add them to these dormant and existing Frankenstein businesses and to basically resurrect them, if you will. So we see that trend to continue to increase. And lastly here, we did see an increase in spike in call volumes from call centers around the overall high fraud risk. So as you can see, many signs, many indicators to indicate, hey, we expect fraud to increase. I'd love for you guys' perspective now to really see, hey, are you guys seeing the same thing within your own customer base, your own portfolio? Just love to get your perspective. If you even have metrics that say, hey, yeah, we've seen X amount of fraud increase, I'd love to be able to hear that. So if you want to be able to provide that in the chat box today or any questions, I'd love to be able to take those and be able to start seeing that now and then also answer any questions you may have at this time.
Here's a specific question on fraud. I apologize. We are seeing our customers being directed to, and we just lost it, directed to a different bank account. The fraudsters intercepts an email from us to them and directs the customer to pay the fraudster's bank account, and the customer loses money.
Got it. Wow. That is definitely could be a significant problem and something actually I've not unheard of before. And I have actually a subsequent slide that will kind of talk a little bit more about how we would help you potentially try to solve or identify something like that. You know, from a fraudster's perspective, during the application process, right, they're going to try and provide you as much information on a true legitimate business as much as possible. So they basically pass your process. Once they've been brought into your environment and now you're doing business with them, they have now seen multiple opportunities to start to modify and change some of the information, right? Because ultimately they want you to reach them, the fraudsters, and not the actual business itself. So it's something that's pretty common where we do kind of a bait and switch in terms of the information that they provide to you. We've seen cases where they switch, you know, last minute change the address that they want to get the product shipped to, for example. And we also seen very good examples where, hey, you know, phone numbers and email addresses are just slightly modified so that they look like or represent that actual true business. But if you do like a side-by-side comparison, for example, you could, you know, clearly tell that they're off by just one letter, but enough where it could trick someone that's kind of looking at it quickly and manually not to identify that. So it's really easy to try to trick someone like that and be able to bring in a solution that's really try to automate things like that or do those quick risk checks for you will go a long ways in helping you prevent things or scenarios from happening. So I'll definitely touch a little bit more on that in some subsequent discussions too.
And Lee, we have another
point.
question, comment here. I think it's an interesting one. Folks will enjoy. We are seeing more and more customers disputing valid credit card charges and other customers using their customer quote unquote credit cards, which is also resulting in dispute. And the question is, how do we fight that? I'm wondering if you have any suggestions you could share with folks.
Yeah, absolutely. And I think what you're illustrating actually sounds like potentially two types of fraud too. I've heard a little bit about, hey, someone misusing someone else's information that really falls in line into, I would say, as I mentioned, more of a third-party fraud. So fraudsters taking someone else's information and misusing it themselves. So we could definitely, that kind of falls right along with what we want to talk about and really help you solve for. And then the second one, to me, that sounds more of a flavor of our first-party fraud, which potentially you could highlight. We have a new model that we'll be able to discuss that potentially could help you solve for something like that too as well, where you focus a little bit more about prior credit history and how they're using their credit right? So you're not only looking at just a point in time, you have that historical information to reflect back and say, hey, have we seen potentially them using similar schemes with another client, another provider, for example. So prior history can help us predict future behavior potentially, right? So I'll speak a little bit more about how we could utilize potentially that score to help us solve for this particular problem too as well. Yeah, please. Yeah, I'd like to dive into this slide because I think it's really important, right? This is such a problem, a huge problem to solve for many of our clients, but why is this so difficult? So in this next slide here, I'll illustrate exactly why this is such a difficult problem to solve. And it really goes to that number in the top left-hand corner there. This is a very lucrative, extremely profitable industry for the fraudsters today. $6 trillion for our fraudsters in terms of prize for them, right? This is a $6 trillion industry. For them, this is actually much larger than all of the legal drug trades combined, which is astronomical if you think about it from that perspective. Then you start to move down into this bottom right section here is that 19 billion identities have been stolen since 2013. So the plethora of stolen identities that could potentially be misused on applications, access to their hands, 19 billion of them since 2013. We have about 7 billion people total in the world. So what this really tells us is that same identity likely has been stolen much more than just once. So as you can see, because of those reasons, we expect those many dollar amounts in the bottom there to continue to increase exponentially in the coming year. This is going to be a significant problem to come. Now, what's coming even to the forefront to compound this problem even more significantly, I mentioned now is the ID records being stolen, 19 million of them. What's coming to the forefront is now identities, full business identities being traded and sold within the market. So for as little as $35, a fraudster go online in the black market, purchase a full business identity with people attached to this business with full credit file, perfect credit history, meant to beat some really complicated systems, especially systems where you have no protection or just doing credit checks today. And I'll touch on again, just how we could be able to combat this problem now. So if we move into the next slide, I want to start going to how we can provide solutions to help solve for this very important problem.
Sure. Lee, you hit a topic. It seems a number of folks are asking questions and some comments. If it's okay, I'd like to just pause you there and ask the questions and go to some of the chat box pieces, if that's okay.
Yeah, please. This is what it's about, right? I love the conversation. So let's talk more about them.
Good. The first comment or question that came in is, we have noted our emails to contact us if an email is received to change banking information. So we have noted on our emails to contact us if an email is received to change banking information. So I think it's an internal control folks are using, it sounds like, to combat some of the bank account detail.
I think that's a very, very great technique and strategy to implement, and something if other attendings have not even considered, something to really look into, right? Because really depends on the type of risk, right? For example, that your customer is asking you to make change. So say, for example, banking information. I think that's pretty high risk. I've touched on now potentially ship to address changes, right? Address changes. I think that's a particular high risk as well. So also thinking about, hey, what are they asking for from you? Are they asking for increase in credit balance, term limits, things like that? So if you have different escalation paths that say, hey, where they're asking for a very specific thing where they increases their exposure and risk with you. So think about implementing safeguards to try and prevent something like that, right? Absolutely. You definitely want to look at it from that perspective. And also one thing to keep in mind too is that some of the treatments you can take or you have been taking on, say, riskier credit decisions, you should also try to consider that applying it from a fraud risk perspective as well. So not necessarily you say, hey, I don't want to establish a relationship with this new customer, for example. When you think they potentially could be fraudulent, you could still consider bringing into them as a potential supplier, vendor, or customer. But in this case, you might want to consider maybe limiting the amount of funds that they get access to or products they get access to or service they get access to, maybe even require upfront deposit, for example.
Yeah, one more question before you get going. This is an interesting one. Do you think a photo ID would help? asking somebody for a photo ID when recognizing or thinking that there may be some fraud?
Yeah, I think when you implement any type of checks, right, it's going to be better than not having anything at all. I will say photo IDs is something that traditionally we have leveraged before, right, just to be able to confirm that identification. I've definitely seen some capabilities by fraudsters where they are beating the system. But if you're implementing anything where you can, hey, get the photo ID and possibly even bringing that person, say, for example, to like a virtual meeting, if you will, that allows you to then take that photo ID and compare that to a real person. That in itself would introduce enough friction to say, if it's a fraudster, they know you're doing that, they may, delay that meeting with you, that virtual call. So that's an indicator that you could then take back and say, hey, maybe I got to slow down the process there. Because fraudsters typically will want to delay that as much as possible. Primarily, we have a lot of Experian solutions today to help you identify and solve many of the problems you're probably likely facing today. Today, I really want to talk specifically about two commercial solutions that we're bringing to the forefront to solve for the two specific attacks that I mentioned. I believe it's going to be forthcoming very shortly here that may impact you specifically. One of them is that fraud score, and this next slide here will kind of go into more detail about what exactly this is. This fraud score here today is a first-party fraud score. And again, this is the one where you have a business, the actual business, not impersonating one, just using their identity trying to apply for credit. A lot of times, first-party fraud, it's hard to differentiate between true credit loss versus first-party fraud loss here, and then using the score will be able to help you do that. Again, if you're using only a solution that really looks at only identity risk, this doesn't really help you solve for that first-party fraud problem. And if you're only using point-in-time solutions to make a risk assessment at that point in time, at that application, without looking at that prior history, you're not going to be able to help be able to identify and solve for this problem as well. So with using our score, this is a commercial-only or blended score with a score range of 300 to 850, where higher the score, lower the risk. This is something you could easily implement as part of your front-end process to help you isolate, hey, do I have a population coming through my application process where potentially it could be high risk? I just want to kind of wrap up here and say, hey, we have an entity verification solution to help you feel really confident also that the identity being used on application is who they say they are. This is where we're trying to give you increased confidence of that business as well as consumer in that single application. We're bringing in multiple different sources that really interrogates the email, for example, allow you to easily compare. Our solution actually already does a comparison between an email address domain versus the actual website domain. So you quickly spot, hey, if they're only one letter off. We're also really interrogating that phone number, whether that's a VoIP, landline, who it belongs to, and whether that phone number was first activated. And also the website, just really focusing on that domain, whether that domain technology has increased over time and that web traffic has increased over time, and that if they're a true business with a true legitimate website, things like that are very, very difficult for fraudsters to replicate. And this next slide here really kind of illustrates the type of questions we want to be able to help you answer in an automated way. If you had an analyst manually review applications today, these are many of the questions that are probably running through their minds. They're trying to answer on a daily basis to highlight this potential risk here as well, right? So using the solution, we're actually able to try and address each of these questions in an automated way. So think about moving upfront digitally and trying to process applications non-manually today. This is how we're able to help you solve for that. And lastly, I just want to kind of close out here. Fraud is something that continuously evolves over time. Fraudsters are always increasing their sophistication, and this is a clear example of that. If you look at 2005, where fraud attacks are really starting, you have phishing schemes where they're trying to steal your identity. So you have Trojans, right, where they get access to your machine and then steal the same information from your machine. Now, when it's in the bottom there in 2020, right, it's become now much more sophisticated, where fraudsters are not only trying to steal your identity, they're trying to mimic legitimate devices. So trying to mimic a legitimate laptop, legitimate iPhones, for example, when interacting with your application. If you don't have something to detect that, you'll never be able to uncover things like that. And then the evolution of the Trojan itself, not only are they introduced, Trojans is still a thing, Now the Trojans are mimicking legitimate software. So even the Windows softwares and antiviruses aren't able to detect because they look like true legitimate softwares that a traditional customer consumer should have on the computer. So the last message here is that, we need to start looking at solving for fraud now. And then there's also should be an eye in the future where fraud is evolving. So it's important to keep in mind that this is an ongoing evolution. As it's a cat and mouse game. As fraudsters are adjusting, so are we. Appreciate everyone's time. And if we'd love to dive deeper on any topic, I know this is a big topic for us all. Appreciate everyone's engagement so far.
Great, thank you, Lee. This is Carl Stronach. Everyone hear me okay? Hear me okay, Matt?
We do. Thank you, Carl.
Okay, great. Sorry I missed the intros earlier. I think you might have heard a little bit from Mike Myers on some of our alternative data offerings, and that's what we're going to talk about here to wrap things up. We call it business activity. Is kind of how we refer to this alternative data set. It's basically all about trying to use non-credit bureau sources to help understand what's happening with the business, and in particular with consumer-facing businesses, and data that we can get from online and social media sources. And so we all know, I'm going to kind of gloss over this one just in the interest of time, but the thing I would highlight to you is at the very bottom left. Based on the current number of active businesses that we see in our database and surveys of business owners related to the coronavirus, about 14% report that they are either fully closed or temporarily closed. We think that number is probably increasing as the number of cases starts to climb up again, unfortunately. But that really translates into at least probably around 3.5 to 4 million business closures in the United States, right? And so business owners are really taking to new ways to offer services to their customers. They're offering pickup, they're doing takeout. Restaurants who were mainly delivering in their restaurant, maybe they had a full bar. They've converted and retooled to do just delivery and just pickup. So we all know that that's happened. And so how can we start to tap into that data? How can we start to understand what's going on with the business to see if they have transformed? Are they actually thriving now due to this, or have they actually closed and gone out of business? And so if we go to the next slide, we see that different industry types are impacted. And in talking with our customers, we know that they have stopped extending credit to customers that have been impacted, such as restaurants, for example. How do we potentially use these alternative data sources to better segment the businesses that are not impacted and likely to be thriving from those that are actually more impacted? A good example, easy one to understand, is restaurants. If I'm a restaurant owner and I want to put in a big order for supplies, how likely am I to be impacted by COVID? If my majority of my revenues were coming from my bar prior to COVID, if I haven't done enough to retool and really close that revenue gap in a new way through delivery or takeout, if I haven't transformed my business, am I more likely to still be impacted? Versus restaurants that are less likely to be impacted. Those who did a ton of delivery before. An easy to understand one is pizza. Pizza is killing it as we right now when we talk to our customers about who's doing well. And I see in the chat as well, construction due to the residential housing boom. People want to upgrade their spaces, people moving to new homes that need renovation. Construction is doing awesome. How can we use that information from online or social sources to confirm that the business is doing well and further segment the population? The data certainly allows us to do that. If we go to the next slide, we've run a lot of customer portfolios lately through the online and social data. And we are seeing around a 3 to 4% closure rate right now in those books of business. And so, we think this is something that's going to keep increasing. We look at statistics from Yelp, for example, that say 60% of businesses that temporarily close are going to be closed permanently. And so how can we, again, tap into that data, understand which businesses are open and closed? There's definitely an opportunity to use the data directly from Google and Yelp, actually, to answer that very question. What we've done is really put together a new way to, again, tap into that Google and Yelp data to help understand the business in a new way on top of what we can get from our, say, traditional credit bureau. And so what you can do is understand if the business is open or closed. The online data provides a way to segment the business that goes beyond a traditional SIC or NAICS code. For example, Google or Yelp will tell you in granular detail what kind of restaurant it is, whereas the SIC code might say just full service restaurant. And also, there's much more expanded firmographics. We can figure out if they're offering delivery or pickup, if they've really transformed their business. We've talked to a few customers who've been able to use, say, the delivery metric. If that restaurant is offering delivery, it provides predictive lift to their models, predictive lift to their scorecard and process that allows them to offer credit to restaurants, again, who are offering delivery and show good credit metrics. So it's really helping restart business activity that had stopped due to COVID and allow our customers to resume growth in areas that they had shut down, which is really exciting. The last thing I'll talk about on the next slide is social engagement metrics. And so our data partner Yelp provides us a way to understand what's happening in the online activity for a business's Yelp profile. It's just another way to understand what's going on with the business that's more granular than, say, a closed indicator. It's a way to spot potential lockdowns as they're happening. And so in this example on the slide, there was a nail salon thriving, doing great prior to COVID. The very week that Dallas put in lockdown restrictions back in March, we saw the engagement metrics, meaning how many people are viewing that Yelp profile page online. We saw the engagement metrics drop by almost 40% immediately the week that the lockdown was put in place. And the story on this business, actually, since that time, they actually were listed as closed on Google and on Yelp. And so they actually never went back and updated their status to make sure that they were listed as open. But they did reopen, and you can call them and they say that they've reopened their business, but they haven't been paying attention to that social media channel. And so they're missing out on a lot of business, which obviously would impact their revenue too. So this provides an automated way to kind of check on the business, see what their status is, and make sure that they're on top of their online and social profiles. Are they doing what they need to do to draw on customers in the current environment? But then also look for businesses that maybe have actually closed or are actually reopening, conversely, as those engagement metrics shift. Matt, do you see any questions or Q&A coming through for us on the alternative data?
We can, and I think I opened it up for Bud. There was one question that did come in, and it relates back to the fraud section that we're going through. And let me just, I'll pose it out there. And it's, we have noted on our emails to contact us if an email is received to change banking information. So it sounds like folks being proactive in a notification to their customers that if they see something, just to recognize it and respond back into them. Looks like Bud's microphone is open. If Bud wanted to offer some closing comments.
Yeah, it is. Thanks, Matt. I assume you can hear me. Yes?
Yes.
Perfect. All right. So I just wanted to thank everybody who attended. Folks, I get that it's tough to sit into these things. It's tough in this environment that we're in not to meet face to face and have these interactions. So everything that you've done and the questions you've asked are much appreciated. If there's something of interest here, you want to have a further dialogue or conversation, these people, and I guess I should introduce myself. My name is Bud Wagner. I'm the VP of Sales for Experian in this particular piece of the business. These folks support us. They support us in a fantastic way, and they love having conversations around our products, what we can do better, what we can do to help customers. So even if you're not a customer and you're thinking about, wow, I really would like to explore this more, you can reach out to your direct sales rep if you have one. If you aren't one of our customers, you can reach out to Matt. Matt can certainly get you in connection with me, and we can go from there. But that's really critical to us. It's so critical, as a matter of fact, that Mike and I are looking to start an advisory council. So there may be some of you who may be getting a reach out as a request to be part of our advisory council to help us develop our future roadmap and look at our processes, our solutions, and our offerings to see if there's something we should be adding that makes us that much more valuable to you guys as you do the business that you do. So again, I just appreciate you being on the call and giving us your attention and your time today. Thanks, Matt.
You're welcome, Bud. Thank you. I think we'll close it at this point. I don't see any additional questions coming in. We are just coming up on the top of the hour, so probably a good time to close it. Before we do, a couple of thank yous. First of all, thank you for all who participated. So our audience that is out there, thank you for spending the time with us and sharing that with the folks over at Experian. I do want to also thank the Experian team. So all of our presenters, Brody, Lee, Mike, and Carl. And just remind folks that Experian is a platinum partner of the foundation. And again, we are truly appreciative of all that they do. At this point, we're going to close it out. I hope everybody has a safe and healthy day. We look forward to seeing you again real soon. And if CRF can support you in any way, please let us know. And again, if you need support from the Experian folks, we can certainly connect you with them. Again, have a great day. Thank you, everybody. Bye-bye.